As usual, I like to start off the show with just a summary of what I saw happening with the stock market over the past week. A lot going on this year, a lot going on this week. I've got a chart here of the S&P 500. You can see, the red line is kind of a trend line, is obviously on the downside. The blue line there is the 200-day moving average, which we're below, and we have, been below for some time. And so one of the things we look at when we're looking at stock markets is what we call the primary trend. And so the primary trend is either up or down. And then in this particular case, the primary trend is definitely down. And there are a couple of key things you look at there. Are you hitting lower lows over time? The answer is yes. Are you hitting lower highs? The answer is yes. Are you below the 200-day moving average? Yes, we are. Is the 200-day moving average going down? The answer is yes. So what we are doing right now is we're investing with the primary trend, which is investing to the downside. So we've got our model portfolios are set up so that we have money in an inverse position that actually goes the opposite direction of the S&P 500. If you're trying to invest to go up, there's been 5 different cases where the market's gone up this year, but all of them have failed, and that's why we call that the minor trend. The rest of the money that we have right now in our models is in T-bills and ultra short-term bonds. Really, this is what we want to do until we start to see a change to a primary trend to the upside. And then we want to get back into our normal models and basically go on our way as far as that goes. And we'll talk about kind of how we got there. And so, first of all, let's talk about some of the things that happened this week. I'll change this to a scene that you might be able to see better. We had the job openings come out this week and actually grew a lot. It was kind of surprising. We're supposed to have 9.8 million jobs, which would have been kind of continuation from that peak and continuing down. This is what the Federal Reserve wants to see. They want to see less job openings because there's almost 2 job openings for every 1 unemployed person, and that creates inflation because they have to pay more and more to get those people to come to work. Well, lo and behold, we ended up with 10.8 million jobs that were reported open last week, which was 1 million more than expected. So market struggled. Actually, we were down every day this week, and this was part of the reason why. And then today we have the jobs report that comes out. So this is looking at what happened with the jobs for last month. And so you can see there's 261,000 new jobs created in October. Well, the expectation was 195,000. So that's kind of more jobs than expected. And again, normally we want more jobs, not less jobs. But in an inflationary environment, more jobs creates more pressure on inflation, which ultimately makes the Federal Reserve raise rates more than they are, which ultimately makes stocks, bonds, and real estate suffer. And so we'd like to see the jobs report come in at expectations or lower in terms of being able to say, okay, we're starting to turn the corner. I will say, if you look at this chart for the last 12 months, the number of new jobs created is on a downside altogether. And so, again, that's something the Federal Reserve would be looking at as a positive. But today was sort of a negative in that regards. We have workforce participation, which is down for the month. It went from 6.3% to 6.2%. I know that doesn't seem like much, but actually every 0.2% is millions of jobs and people, basically. And you can see that it was over 63% prior to the pandemic. And so this is one of the problems. People are not coming back to work at the same rates, yet we have all these jobs and this growth in the economy, and it's creating a very tight labor market, which is inflationary. And so that is a bit of a problem as far as the Federal Reserve is concerned. We did see, and this is kind of an interesting chart, the green line there shows how much year over year the hourly wages increased. And you can see what happened in 2020, when things fell, et cetera. And then the gray line there is the consumer price index. So one of the problems we're having right now is that costs are going up faster than wages are going up, which creates a tighter situation, creates problems inside of industries. Luxury goods might have a difficult time doing well here. People are looking more for, the necessities as far as that goes. But if you do look at it, that 4.7% growth in October, it's down a little bit. That trend, peaked out more or less when the CPI peaked out. So again, actually, the market would look at this as a positive because we need to have softer growth on wage increases. If wage increases continue up and up and up, that means the companies have to pay more, which means that they're going to pass that or try to pass that along in higher prices, which makes higher inflation. And they call that wage price cycle, the inflationary cycle. And if they don't increase their prices, then they lose earnings, right? They compress their earnings, and earnings are one of the biggest drivers for the stock market. So this is actually a really important component. When this report came out this morning, the market actually jumped 2%. As we speak right now, it's all the way back down to basically where it started. And that is because if you really look at the whole report, there's a mixture of different things that have happened as far as that goes. And then lastly, the report showed the unemployment rate actually grew. It was supposed to be at 3.6%, and it was at 3.5 last month, but it grew to 3.7%. And so again, unfortunately, in this environment, that's seen as a positive for the stock market, because again, it shows some softer aspect of the of the labor market, which is a big. We have two real problems for inflation. One is supply chain, trying to get things through, get it from China or wherever it is. The other is labor, trying to get things done or delivered or serviced or what have you. And so having a softer employment situation is going to be better from an inflationary standpoint. Now, when Chairman Powell spoke on Friday after the Federal Reserve meeting, he talked about this is a hot job market, very strong job market. And again, when they're talking about that, that's not a good thing in the sense that that means they feel they can raise rates more and more and more. And actually, specifically at that meeting, he talked about the fact that they felt like they were going to have to go to a higher peak rate than was expected the month before in the previous meeting. And that was the point when the stock market dropped. And we ended up down 2.5% on Wednesday after the question and answer period that they had. And so this reports altogether are showing, I think, kind of a tight labor market. It's softening up a little, which is a good thing in terms of the stock market, but not a lot yet. So that's going to be really interesting to watch how that plays out. We had one other really interesting thing happening this week, and this is a chart from iShares. This is a China ETF. And so you can see it's down a lot, right? I mean, it's the 200-day moving average line there is basically down at what, pretty good clip. But there's a big jump here that's happened this week, and that's actually affecting things. We're seeing big jumps in the European market today. This is up 6% today. And so what happened was there was kind of a rumor / social media post that talked about reducing the zero COVID policy and kind of reopening China, which is kind of ironic because at the same time we've locked down Shanghai, Disney. We've had this Foxconn plant area closed down, and all because of COVID cases. But the market has been running with this, even though the government came out and said, well, no, we really haven't changed our zero COVID policy. We're going to, see some run here, partly because I think it's really down a lot. Before this happened, before that rumor came out, I saw a lot of analysts saying, hey, it might be time to start accumulating Chinese stocks. This is something to watch. I know it's not here in the U.S., but if this market takes off, sometimes these big markets can kind of carry other things with it. So we'll see what happens. I will say that emphatically, the government over and over has said that the reason that they have to use the zero COVID policy is because they don't have enough hospital capacity to take on a large surge of COVID cases. And so, they're going to be in this cycle until they figure that out. They add more hospital capacity, or they come up with some other, start using a different vaccine, and there is some talks that happened about the possibility of using, say, the Pfizer vaccine in China. So, of course, that would take some time, right, to get out. You got to get people to do it and those types of things. But those could be positive developments. But something to watch here that we don't normally talk about, but I think is important. So we have talked about this before. The leading economic indicator is down. The blue line there shows the leading indicator. The gray line shows the actual economy. If you look closely, the blue line comes down before the gray line, right? And we just came down a lot since February. But it can be kind of early. So if you look back to the 2008 downturn, which is the big gray bar there, That was topped in October of 2006. The bottom of the market wasn't until March of 2009. So again, this is one of the reasons why we are being conservative, because this is projecting a recession. And then this week, we got another piece that came through. Probably the most accurate projections for recession is the inverted yield curve between the 3-month and the 10-year. So in this particular case, what this chart is showing is this negative 0.11%. What that means is that the 3-month T-bill is paying more than the 10-year Treasury, which is pretty incredible if you think about it. So you can give the government your money for 3 months, make more money than you would if you gave it to them for 10 years. And the reason that that is inverted is because the expectation for the bond market is that the future is going to be soft, right? The recession is coming. And when this inverts, the average time to recession is 12 months, so say October of next year, although it can be as short as 5 months and as long as 22 months. This is actually a big study that the New York Fed did on this inversion, had a 94% accuracy rate for a recession, as long as that inversion continued for 2 to 3 months. So, it's just starting, but it is a big deal that it did invert here as far as that goes. So, one of the questions then is, okay, great, market's in a downturn, the primary trend is down. How do we know when one of these things isn't the big turnaround, right? Because look at how many, I'll put some arrows here. Look at that. So we have all of these green arrows were bottom points where theoretically you could have said, okay, that's the bottom. Now we're going to come back up. And all the red arrows are where it failed, where it stopped. And so we've had 5, right? Including the one that we just had in October, which was a 13% run from that low to the high point that happened. And so how do we know when one of these is going to be the one that really runs, gets through that 200-day moving average, and we turn this primary trend back into a positive instead of a negative trend? And really, I think the number one thing you have to take a look at there is the 2-year Treasury yield, okay? So if you take a look here, this is the yield on the 2-year Treasury over the last 12 months. It was a little less than 0.5%, 12 months ago. Now it's a little bit more than 4.7% in that range. And so all the way through, and if you go back and you look and you say, okay, take that green arrow, look at where the 2-year Treasury was, and then when it gets to that top point, was the 2-year Treasury higher or lower than it was at the green arrow? Every point there, it was at least the same, if not higher. So what the market's telling you is the stock market's making these runs. You got short covering, you got all these different things, you got dip buyers. But as long as interest rates continue up, and this is basically a projection of what the Federal Reserve is going to be doing, you are going to probably see those runs fail. We need to see the 2-year Treasury fall in yield at the same time that the stock market's running, in my opinion, in this environment, before we should really be excited about this particular run-up. And so then you ask, okay, how do we know when the 2-year Treasury is starting to turn over? Some basic concepts. Got some trend lines in here. You can see those red lines. This is very steep, right? I mean, it's not curling at all right now. It's going straight up pretty closely. We got that blue line there with the 200-day moving average. Maybe we get back down to that. These are some basic things. Another basic is just a moving average crossover. So the purple line there is a 10-day moving average. The red line's a 50-day. When the 10 crosses through the 50, right, maybe that's a point to be, out of the, being back into the stock market, because we're starting to see that long position. So a combination of the stock market, moving up with the 2-year Treasury kind of curling over to the downside is really what I would be looking for here. Prior to that, the risk is quite high. And I think that's going to kind of play out a couple different ways. Either inflation is going to continue, because we keep seeing core inflation go up. It's supposed to be going down. It's been going up. PCE, which is the measure that the Federal Reserve likes, or CPI, in both cases over the last couple months, core inflation has been going up. And so you're going to have to kind of finally get that to come down slowly but surely. They're going to continue to raise rates. And, we could have this long period of time where we're trying to fight that. The other way is that they're raising rates, they're trying to fight this, and then something breaks. And then all of a sudden, boom, and so that Lehman Brothers moment, and something happens out there because of these higher rates and the higher dollar that creates an economic crisis, essentially, a financial crisis. That brings the rates down fairly quickly, probably as they try to fight that crisis and go the other direction to try to support things. Might also bring down inflation as people start to pull back on their spending in that financial crisis, much like they did in 2008. So, that would accelerate things, but you're probably talking about a much bigger stock market drop too, probably in the neighborhood of 30% from where we are, possibly, because of that breaking. So it'll be very interesting to see how this plays out. But those are the things that we're looking at right now. That's kind of my outlook on what's happening. We did get some good news this week in terms of the jobs report, I feel, but there's enough bad news in that jobs report that probably keep the Federal Reserve going on the interest rate increases. And, we have to just continue to watch the yield on the 2-year Treasury. And I think we'll get a better idea for what's happening. So, yeah, so that's what's going on today. And we'll make sure we cover this again next week.